Well, big news today in Canadian mortgage world. Some new, I think, surprising mortgage rule changes were announced by the finance minister, Chrystia Freeland, today. So I'm here to talk with LeeAnn Ross and Jason Dodd from First Foundation Mortgages about those changes, and just get a recap of the news and talk a little bit about those changes and how that might impact people coming up on purchasing a home or renewing their mortgage, things like that. My name is Gord McCallum. I'm the owner and CEO of First Foundation. And LeeAnn, why don't you tell us a little bit about yourself?
I am an Edmonton-based mortgage broker. I've been doing this for 8 years. Yeah, that's me in a nutshell.
And JD, as he's affectionately known.
I've been, I'm a Calgary-based mortgage broker, and it's crazy to think that it's been a little over 20 years since I've been in the industry, and primarily with residential, and trying to dabble a little bit into the commercial and construction side of things. But that's my background in this industry.
Right on. Well, you and I both were getting up there. I remember when I first got in the industry, and there were guys and gals who had been in it for 20 years, and I thought, they're so old. Now I'm one of them. So
no, that's me.
And the worst part is LeeAnn knows more than the two of us combined, and she's been doing it for half as much time. So
yeah.
Okay, well, let's talk about these changes, guys. There's three main changes. I think three that I've identified. I don't know if there are any others. As usual, sometimes the details are going to be figured out later on after an announcement like this. But my understanding is the three main changes are, first of all, they've increased the cap on the size of a mortgage you can get with CMHC insurance in place, or insurance in general. Previously, that was capped at $1 million. And what that meant was, if you wanted to put less than 20% down on a purchase, the value of the home had to be $1 million or less. Is that correct? That's interesting. Yep. So they've increased that now to 1.5 million. And we can talk about the reasons why and what the implications might be for that in a minute. That's the first change. Second change was they have increased the maximum amortization period from 25 years to 30 years for all first-time buyers and for anybody who purchases a new home, so new construction. Earlier this year, there had been an announcement about 30-year amortizations, but exclusively for first-time buyers of new homes. So this is an expansion on that policy. And then the third big change is the ability to switch or transfer, I think those terms are used interchangeably, your mortgage from one lender to another lender at renewal without having to requalify based on the stress test rate or the mortgage qualifying rate. That's a big change. So Jason, why don't we start with you? Tell us a little bit more about this increase from $1 million to $1.5 million in terms of home value, and how that will impact buyers.
Yeah, well, I guess we've just had, all of us as brokers and in this industry, have had a couple of hours to digest it, but so it's hot off the presses. But it was pretty timely for me, and so I always kind of like to relate it to what's happening really on the real mortgage kind of road with our clients. And to be honest with you, I have two clients that would be actively engaged in it. And when I say that, it's not like it's a common theme that I have clients in the million plus that are typically putting less than 20% or want to. Typically, a lot of my, I guess you would say, seasoned buyers that are buying in that price point have significant down payments. Yeah, when I closed a little while ago, 1.6 million, they are putting 1 million down, right? So it doesn't typically happen, but I had some young buyers who are planning on having some money coming down the road. The price point's 1.2. They only have about 150,000, and I told them about this, and they're like, we'll have to continue to save or wait. I gave them the news today they might be heading out, and why that's functional for them is they know that there's sizable amounts coming down the road, but they can lower that, take a shorter term, renegotiate at a point. And then I've got a gentleman who's actively looking right now. He's a professional and he's got quite a bit wrapped up within his company, so he doesn't want to take that out. He's looking at the 1.2 range, and he only has about 100,000 now. I gave him this news and he heard about it, and we almost emailed each other at the same time today.
Wow.
So it's not going to be a large number, especially maybe markets like mine, specifically at Calgary and Edmonton. Like Calgary, maybe a little bit where the price points are getting up, but I would say that it's targeted to areas like the greater, larger areas in Ontario, places in Vancouver, surrounding area, maybe some interior BC portions where those price points are at or greater, just even to get into even the smaller homes. So I think it will serve some purpose, and I think that there is a market out there, and albeit a smaller one, but it's going to help a little bit in that sense. And I know that there's lender targeted programs for, say, doctors who are just getting started out, and they're probably going to see some elevated income as their years progress, but maybe are carrying student loan debt or don't have a lot saved, and this could be useful.
Well, you bring up an interesting point. So it sounds to me like there's maybe a financial planning component to some of this change in particular, where some might, for whatever reason, whether they've got future income possibilities that they haven't realized yet, or they have another need for their existing capital. So maybe they have the money to put a bigger down payment down, but the return is greater having it in their company, for example. So there's a productivity argument there. Maybe I'm better off putting money in my organization because I can turn that into a 10 or 15 or 20% return rather than using it for a down payment and offsetting my interest costs by 4 or 5%. Or maybe there's an inheritance coming, or some family estate planning things that are happening that where if there's an opportunity to purchase in a market now, as opposed to the cost of waiting, especially in a rising price environment, you may be better off to eat the insurance premiums or put the money up now and buy it sooner, and then plan around that. So yeah, you make some good points, I think. Do you think that there's from a government standpoint, what's the benefit to the government in announcing this change right now?
Optics. It's that time of year, and there's some things happening on the political scope. I guess that looks good. Although I guess not to kind of throw them too far under the bus, I would sure that like those areas I mentioned are probably been asking for something like this, and in that case they're listening. But I was never a big fan of it anyway, because when you're looking at the qualification guidelines to get into that size mortgage anyway, this isn't something that's just getting handed out, at least right. From our perspective anyway. You come in and you want a $1.2 million mortgage, that's a big carrying cost. And LeeAnn, you can correct me if I'm wrong, it might be about $560 for every 100,000 borrowed. $2 million mortgage, your monthly bill's getting up there just to carry a mortgage payment, but you'd have to be pretty well heeled to carry it. So I don't think it's something that's lighting the market on fire with options. I think it fits a small demographic, and it helps, and it's part of the market. But yeah, I think it's just part of, if you want my opinion on it, I think that there will be more announcements as we come along. I think, and that's my guess, it's that the qualifying rate, I think, will change. I think people have talked about that long enough, saying it's just an arbitrary number that they've made up for this, and it's just stayed stagnant for quite some time. And if they're really wanting people to help qualify and help them in the homes, then maybe they look at something like that. Maybe it's plus 1% instead of plus 2%.
Well, let's talk about the math. Do you mind if I interrupt you there for a second?
Yeah, go ahead. Yeah.
So it's a pretty substantial difference. If somebody was to buy $1.5 million home before, under the old rules. Now, and keep in mind, I don't think these rules go into effect until December of this year. We don't have a firm date yet. Some of the other details I'm sure will be announced. But under the current rules and the old rules, you had to put $300,000 down minimum to purchase a $1.5 million home, 20%. Now, under the new proposed rules, if you put 5% down, you would only have to come up with $75,000. So that the $225,000 difference, that's money that can be used for other things, or maybe you don't have it. But you're still going to need somebody who does that is going to need a pretty substantial income, regardless, like you said, to service the debt and make those payments and to qualify in the first place. So it may be a small market. In certain parts of the country, it'll be a little bit bigger. And maybe there's pooling of incomes and things like that going on to make that work. I want to move on if it's okay. Thanks, Jason.
Before we move on, Gord, just a small correction on that, because leading up around the election time in 2015, they changed the rules on high ratio, 500,000, 5%. Anything above that is 10%. So it wouldn't be 75,000. It would be higher. I can't math it in my head right now, but it would be higher than 75,000, but it would be the minimum, right?
Okay,
So
okay, that's a very good
the
point.
additional million would be, I guess on the 500,000, you're borrowing 1.2, 700,000, that'd be another 70,000 on that 25. So you'd be about 105.
Okay.
And probably going to get mistakes pointing in there, but yeah, roughly around there.
No, thanks for pointing that out. That's good. The math matters. So,
on that note as well, a lot of the lenders have a sliding scale, and it depends what market you're in to determine minimum down payments based on the purchase price. So how this news is going to affect that, we're going to have to wait and see what the lenders come back with on their sliding scales as well. So even these numbers might not be accurate at a later date.
So from a regulatory standpoint, they might say this is what's possible, but the lenders always have the ability to rein that in too, depending on whether you're in Saskatoon or whether you're in Scarborough or whether you're in Burnaby or whatever. Exactly. Okay, excellent points. And that's one good illustration of why it's helpful if you're interested or have questions about this to speak with a licensed mortgage professional like these two, because they know what they're talking about. And those little nuances are sometimes lost in translation. LeeAnn, perfect segue to you to talk about the 30-year amortization rule. So this is a rule that proposes to allow for up to 30-year amortizations. People don't have to go that long if they're a first-time buyer or anybody who's buying a first-time home, or a new home that's newly built. Tell us a little bit about how that's going to impact the market from your perspective.
So the market's a little different here in Edmonton. So I'm going to talk in more Edmonton numbers. And I'm a real numbers person. That's what makes it make sense in my head. So I ran the numbers for a home purchase of $430,000 with the minimum 5% down payment. And then of course you add your mortgage default insurance premium on top of that. And if we're looking at a 25-year mortgage, the payment would be $2,290. So $430 purchase price with minimum down payment on 25 years, $2,290. If we were to stretch that out to 30 years, that exact same purchase, the payment comes down to $2,078. So just over $200 a month savings, which for some people can definitely be a lot of money. That's a couple of weeks, well, maybe a couple of days of groceries with the way things are right now. Alternatively, if you're comfortable with that bit of a higher payment, if you wanted to have a 30-year amortization, that purchase price could actually even then increase. So someone who only qualified for $430,000 would actually now qualify for about $460,000 with 5% down payment. And then that payment comes in at $2,225. So if you're comfortable with that payment, you can actually qualify for more. So option A, lower monthly payment. Option B, you qualify for maybe a larger house, maybe a finished basement, or whatever the case may be. Now, the downside there is that by taking those extra 5 years to pay off your mortgage, you're almost going to pay about $50,000 more in interest over that extra 5 years,
Oh.
Which definitely is not a small chunk of change. So
yeah, what options do people have if they, let's say they want to take the 30-year amortization now because it's available to them, it does reduce their monthly expenses by $200, or allows them to qualify for a home that's more suitable for them or their family. Do they have the ability later on to get back on track with a shorter amortization period, maybe go from 30 years to 25 or 20? What options do people
absolutely.
have?
There's all of the lenders have prepayment allowances. Majority of them are 20%, 20%. So what that means is every year, some are anniversary year, some are calendar year, you can increase your payment by up to 20%. And then you can make up to a 20% lump sum payment on your original mortgage balance per year as well. So tax return, perfect. You get a couple $1,000s back, you can plunk it down on that mortgage. So even though you're taking a 30-year mortgage now, you can actually throughout that 30 years catch back up and pay it down, maybe even less than 25 years. You might end up paying it off in 22 years if you really get into the allowances that you're allowed to prepay without penalty.
Oh, you explained that really well. So it sounds to me like this is a tool that people could use to qualify now. And often when you're a first-time home buyer or you're buying a new home, you're purchasing at a time when your income isn't, maybe you're not in your optimal earning years, you're starting out in your career, you have future earnings that you would expect to go up, or you just may have more expenses because moving is expensive, let's be honest, and you want to maximize your cash flow early on in the process, but give yourself the flexibility to pay more over time and pay it off just as quickly. So that sounds like something that could work for a lot of people.
Absolutely.
Good, thank you. I might come back to that because there's some supply and demand questions I have for you guys about how this could work. The third change I think we should discuss though is the change that they've announced, which allows people who have an existing, so this is geared towards existing homeowners, existing mortgagees, people who already have a mortgage in place. They qualified when they purchased their home under the stress test, or this mortgage qualifying rate, or MQR we call it. And when the original stress test rules were announced, one of the major flaws we identified as mortgage brokers, and I think even Mortgage Professionals Canada, which is our national industry body, has been pushing for, is a change, is this portion of the rules that require somebody who's switching their mortgage at renewal. So for example, let's say I have a mortgage at one of the big 5 banks, and my mortgage comes up for renewal. They give me a renewal offer. I don't need to qualify to accept their renewal offer. I just sign the paper, I stay there, and everything's good. But let's say there's a more competitive offer down the street at another financial institution, whether it's a bank or a credit union or a monoline lender. If I wanted to switch my mortgage to that other institution, I would then have to requalify. So submit my income documents, et cetera, and in order to accept that offer from the second institution. So it puts that at the new institution at a disadvantage. It puts me at a disadvantage. The incumbent lender says, we've got you kind of stuck. So here's the market rate. Here's our renewal rate. Take it or leave it. What are you going to do? Because it's a pain to have to requalify. You may not requalify. So this proposal sounds like it's going to get rid of that. And now it's a level playing field between the incumbent lender and anybody else, any other institution who wants to make you an offer to move your mortgage over to them. I'm a big fan of this change. I think this is probably the most significant change in the batch of 3 from a fairness and competition standpoint, and one that's actually going to bring rates and borrowing costs down for Canadians. What do you guys think about that?
I'm excited about this one as well. There's been a couple of times in the last few years where my clients are minimum wage employees, and their minimum wage hasn't increased a lot in the last 5 years since they purchased their house, but their debts have increased. And when we went to move them to a new lender at a lower rate, they didn't qualify. We couldn't move them. They were stuck at the lender that they were at originally, which a great lender. And at the time it was a great rate, but their renewal offer wasn't fantastic. And we could get them close to a 0.5% lower elsewhere, but they didn't qualify because their income hadn't changed enough to allow for this stress test to be added on again at a higher rate initially. So their contract rate was going to be higher, plus that stress test. So they didn't qualify. So they had to stay at the lender that they were with, which really limited their options and, wasn't ideal for the client. So
Cost
I'm
them more
really
money
excited
no matter
about this
what.
change.
Yeah. Jason, have you got any thoughts on that change, or what that could mean for competition? Because one of the things that's coming up, we know statistically speaking, is there are a ton of renewals coming up in the next year or two that are all at very low rates, and everybody's trying to figure out how to best serve their clients. I'm sure existing lenders are wanting to retain them. Mortgage brokers are wanting to find the client the best offer that's out there for them. Does this help with that? What do you think?
Yeah. No, give me 2 seconds because my battery is running low. Going to.
And celebrating a birthday there as well, Jason, we
Or-
see.
Oh, we may have lost them. Well, we'll come back to it. I think, like I said, I think this is the greatest of the three changes. It's the one being least discussed. I don't think that this distorts supply and demand at all, LeeAnn, because that's one of the concerns. On an individual level, the first two changes can really be helpful to somebody. If you can get your costs down by $200 a month or qualify for a little bit more, that's great. If you can extend that amortization period, or put a little less money down to give you that flexibility. Those are all good on an individual basis, but some people have criticized these rule changes because they say they actually increase demand right now when we don't need more demand. Okay. And they may lead to higher prices as a result, because anytime you make it easier to borrow, it can increase demand. So that's one of the macro risks to the Canadian economy, is we don't really need more demand right now. We need more supply. What are your thoughts on that? Jason, let us know when you want to come back on.
Yeah, maybe we'll start back where you had me, and I rudely interrupted you guys there. But I like the change, like you. I think it's necessary. It was a competitive disadvantage for clients, really, in a small sense, us, right? Because it just limits our ability to go back to clients and give them something. And we've seen that a lot. And maybe, LeeAnn, you're the same, where clients had to readjust after COVID and employment. And there was some concern with clients about either their job length with new jobs they're taking, or self-employed status. And so I think it just, the net positive is it's going to be easier for clients and give them more options overall. So I like it. I don't really have anything kind of, in a sense, negative to say about that. I think it's good. And I'm assuming it's going to be contract rate that clients are qualifying on. I don't know if that was detailed.
Well, will they have to qualify at all?
Oh, really?
From an income standpoint, well, they don't have to qualify to sign. I guess they would. have to qualify.
Contract rate.
Yeah. You don't have to qualify. So the incumbent lender still does have an advantage in the sense that you don't have to qualify at all.
Correct.
Right? At renewal, your qualification is your signature. They make you an offer. If you like it, you sign it. If you don't like it, maybe you go out and get a competing offer to try to negotiate them down a little bit and sign that. So it's not a completely level playing field in that you still will have to qualify with the new lender. You just won't have to do it at this artificial rate of contract +2.
But there are no fees in switching either. And a lot of clients don't understand that or don't know that fact. If you're with one of the big banks now and we're going to move you to another lender at a better rate with better terms, more better, maybe lower penalties, better prepayment, something better for your situation, there's no cost in switching your mortgage from one to the other. Generally speaking, there are a few cases where there are a few $100 costs, but for the most part, the new lender covers that legal fee to move you from the other lender to them. So there's not always a fee. Yes, it's a little bit more of a painful process because we're going through all your income docs again. But that's really the worst of it.
So there's a time commitment and that kind of thing. And so everybody has to decide, is that worth it for me or not? If you're going from 4% to 395, maybe it's not worth it. Maybe the extra effort and hassle of going through the qualification process isn't going to be worthwhile. On the other hand, if you're getting a substantially better renewal offer with other terms and conditions that benefit you, you may choose to go through that. And that's a discussion to have with your broker as well. Okay. No, excellent points. Excellent points. Well, I think that covers off the main three things. I think the biggest criticisms of these new changes, particularly the first and second rule changes, are that they may actually increase demand at a time when we don't need increased demand. We've got a lot of people moving to Canada that are coming here and driving up demand as it is, and there's a shortage of supply in many markets. So that's keeping house prices high and maybe artificially high in some markets. This may not help that. This may actually just make it increase demand. And on the counterpoint, though, it looks a little bit like there's an incentive there for builders to produce more supply. So there's going to be these competing priorities. There's going to be increased demand. How fast can the supply catch up? Will the prices just continue to rise and then negate a lot of these changes within a short period of time? I think time will tell on that, but there's some good analysts out there who think that these might be inflationary changes. And then the third one, of course, with the switch, should actually bring rates and borrowing costs down for a lot of people who have existing mortgages. And I think that's where maybe the best opportunity is for people as they go into renewal season next year. So I know that's exciting for us. It just gives people more flexibility, more options, and creates a more competitive market, which is good for consumers. So any other last thoughts, or just want to thank you both for your research on this and your opinions. I think it's good to discuss it, and we'll see how things play out here in the next few months.
I think it's just important for people to know that, I'll speak on behalf of the brokers in our office anyways. And, we're always happy to answer questions, whether we are assisting with your current mortgage or we're going to assist you in the future or not. If you just have questions, we're happy to answer questions as best we can. Like you said, there isn't a ton of information on these changes just yet, but as it rolls out, we're happy to just help out wherever we can.
Yeah, as always, the devil's in the details, and you won't get all of them from the media. There'll be some high level overview there, but I think to get the real scoop, you're going to need to speak with a professional. So great advice, LeeAnn. Thank you, Jason, as well, both of you, for discussing this with me, and have a great rest of the day.
You too.